Hello and welcome back to the UK Mortgage Market Insights. It's Friday, the 12th of June 2026. And as always, because it's Friday, I'm going to run through everything that's moved in the mortgage market this week. We have got quite a bit to get through because lenders have been cutting rates again, but the story behind those cuts is more complicated than it looks. Swap rates have nudged upwards. The situation in the Middle East has got worse, not better. And this morning, we got fresh GDP figures that add another piece to the puzzle. All of that matters because it feeds directly into what happens next with inflation and with the Bank of England. And speaking of what happens next, I want to make sure that you stick around to the end of this video because next week is honestly one of the most important weeks we've had in a long time for the mortgage market. CPI inflation data comes out on Wednesday, labour market data on Thursday morning, and the all important Bank of England base rate decision is also next Thursday. Any one of those would move markets, all three in the same week could be significant. So make sure you're subscribed so you don't miss next week's video. Right, let's get into it. So there have been a fair few lender rate reductions this week. TSB have cut rates by up to 0.25%. HSBC have also reduced their rates. Coventry Building Society have cut across both residential and buy-to-let. Atom Bank have reduced their near prime rates, which is worth noting if you've had any credit issues in the past. And Principality have made some marginal reductions, mainly focused on product transfers. Now, the product transfer theme is very prominent this week. Precise, Virgin, Nationwide, and Accord have all focused their reductions on product transfers and switcher ranges, and that is not a coincidence. This tells us that the new business market is quiet. Lenders are not getting the volume of new purchase and remortgage applications that they need, so the focus has shifted to holding on to customers they already have. It's cheaper to retain a customer than to go out and find a new one, especially when the market is as competitive and as uncertain as it is right now. And that uncertainty links directly to what is happening in the Middle East, which brings me on to swap rates. Swap rates, as we all know, are the financial benchmarks that lenders use to price fixed rate mortgages. When they go up, mortgage rates tend to follow. When they come down, you'll see lenders passing on reductions, some quicker than others. They move based on what the financial markets expect to happen to interest rates in the future. Now, this week, both key rates have moved upwards. The 2 year swap rate has gone from 4.07 to 4.17 this week, a rise of 10 basis points, and the 5 year has moved more marginally from 4.173 to 4.188. The 2 year moving more sharply than the 5 year is significant. It tells you that the markets are pricing in near term uncertainty more aggressively than longer term risk. People are nervous about what the next 6 to 12 months looks like, and that nervousness is being driven by what's happening with oil prices and inflation expectations, both of which connect back to the Middle East. Which is why when you see lenders cutting rates this week, you have to understand the context. They are cutting because margins are tight and they need the business, not because the underlying picture has improved, because it hasn't. So, talking about the Middle Eastern oil prices, let's give you a quick update on where things stand globally, because it is directly relevant to your mortgage. There have been no meaningful peace talks between the US and Iran since mid April. This week, Iran confirmed it sees no serious will on the other side to reach any kind of framework agreement. US military strikes against Iran continued this week for a second consecutive day, and the situation is not improving. If anything, it's heading in the other direction. Brent crude oil this week has been pushing towards $95 a barrel, and to put that in context, that's roughly $24 a barrel higher than it was a year ago. The near total closure of the Strait of Hormuz continues to tighten global energy supply, and when energy costs rise, inflation follows. Now, the Bank of England's own projections had CPI running at 3.1% in the second quarter of this year, rising to 3.3% in the third quarter, and then going higher still in the fourth quarter. Those projections were made in mid April before this latest escalation, and therefore the picture could look worse by the time the next forecast is published. The British Chambers of Commerce are now forecasting inflation could push towards 4% by the end of 2026, and that's a long way from the Bank of England's 2% target. And that has a very direct bearing on what the Bank of England does with the base rate. Now, this morning, the ONS released the GDP figures for April, and they give us a useful, if slightly mixed read on where the economy actually stands right now. Monthly GDP contracted by 0.1% in April. That follows growth of 0.3 in March and 0.4 in February. So after 2 decent months, April was a step backwards. That fall was driven mainly by 0.2% drop in services output, which is the biggest part of our UK economy. Construction actually grew a touch by 0.1%, and production showed no growth either way. Now, before anyone reads too much into 1 month's figures, it is worth looking at the bigger picture. Over the 3 months to April, compared with the 3 months to January, GDP grew by 0.7%, which is actually a slight improvement on the 0.6% growth that we saw in the 3 months to March. So the underlying trend is still one of modest growth. It's just that April itself was a soft month within that. Now, here's why this matters for everything else we've talked about today. April was before the latest escalation in the Middle East really took hold, before Brent pushed up towards $95 a barrel. So, if the economy was already cooling slightly in April, on top of inflation that is expected to head higher and a base rate decision that is genuinely up in the air, you can see why next Thursday's data, CPI, the labour market figures, and the MPC decision carries so much weight. It's another reason why nobody can say with confidence where things are heading right now. The base rate currently sits at 3.75% following the hold on 30th of April. And the next decision is next Thursday, the 18th of June, which is why next week matters so much. Now, the market is genuinely split on what happens next, not just next Thursday, but over the rest of 2026 and heading into 2027. And I think it's worth being honest with you about just how divided opinion is right now. JP Morgan think there could be a rate rise as soon as next week. The National Institute of Economic and Social Research have warned that if energy costs stay elevated for a sustained period, rates could climb to 4.5%. ING, on the other hand, think a June hike is unlikely, given some recent falls in oil prices and weaker economic data, but they're not ruling out a move at the next meeting. Oxford Economics sits at the other end of the spectrum and believe rates will hold at 3.75% for the rest of this year and well into 2027. And that's where I tend to sit as well. And in a recent Reuters poll of economists, 33 expected no change, 14 expected at least one hike, and 15 predicted a cut. So what that tells you is that nobody knows with any certainty. And when the market doesn't know, it prices in risk, which is why swap rates are moving upwards even when lenders are cutting headline rates. The two things can happen at the same time, and this week they are. What we do know is that Wednesday's CPI inflation figure for May, Thursday's labour market data, and the MPC decision will between them tell us a great deal more about which of those scenarios we are heading towards. It is genuinely one of the most important sets of data we have had in months, and we'll cover all of it in next week's video. Now, there's been no significant criteria changes to report from lenders. The focus again has been mainly on rate movements. So let me bring all of this together for you and tell you what it actually means for you if you're a borrower, a buyer, or somebody thinking about remortgaging. First, getting proper mortgage advice right now is more important than it has been for a long time. The market is complicated, the outlook is uncertain, and the decisions you make in the next few months could have real consequences for your finances as we head through the summer and into the autumn. If you're thinking about buying a property, please do not fall into the trap of falling in love with a house and offering the asking price without doing your research first. Sellers are still, in a lot of cases, struggling to accept that affordability is reduced and that values have come down. This is still very much a buyer's market. You have negotiating power. Use it and use a mortgage broker to help you understand what you can genuinely afford before you make any offers. And on that point, do not rely on an online affordability calculator to tell you what you can borrow and then borrow right up to that number. What you can afford on paper today may not be what you can comfortably afford in 12 months' time. With inflation potentially heading towards 4%, with energy bills likely to rise again in the autumn, with this morning's GDP figures showing the economy cooled in April, and with real uncertainty about where base rate goes, borrowing to your absolute maximum right now carries real risk. Your mortgage payment is fixed, your other costs are not. Think carefully about affordability, not just today, but in 12 months, 18 months, and 2 years. That is a conversation you should be having with your broker. And finally, next week is a week to pay close attention to. CPI on Wednesday, labour market figures, and the MPC decision both on Thursday. These releases will go a significant way towards telling us what the mortgage market looks like as we head through the rest of the summer and into the autumn. It really could not be more important, so make sure you're subscribed so you can catch next week's update. So that's everything from us for this week. If you have found it useful, please do give it a like, leave a comment below, and if you haven't already, please subscribe. I'll be back next week with a full breakdown of everything that happens with those 3 big data releases. Take care, and I'll see you then.